Next sojourn is going to be in sectors 2 or 1, which is, like I said, deflation and recession. And then you'll see the inflation coming. Because I mean, the price of gold is real money. So, look at gold as measured in yen. It's going it's going through the roof. Gold just exposes a fiat currency for all of its disgusting flaws, and we've abused our world reserve currency status for a very long time. I think gold is benefiting from many things, not only the fact that inflation has already destroyed the middle class, but it's also looking at countries around the world that want to get out of dollar hegemony.
Historically, gold has demonstrated the ability to maintain its purchasing power over time, often outperforming other assets during periods of rising inflation. Over the last 2 years, as an average of 5.91% has increased the price of gold, U.S. inflation has also risen by an average of 6.6%. MichaelPento, president and founder of Pento Portfolio Strategies, focuses on precious metals in relation to inflation. Based on his analysis, MichaelPento predicts that we will face unprecedented stagflation after the next recession. Regarding international currency affairs, Pento notes a clear trend of central banks increasingly moving away from the US dollar, diversifying into other currencies and precious metals. Recent data from the IMF's currency composition of official foreign exchange reserves point to an ongoing gradual decline in the dollar's share of allocated foreign reserves of central banks and governments. Considering his inflation-deflation economic cycle model, MichaelPento believes our next phase will indicate deflation and recession. He predicts inflation will then surge, as reflected in the rising price of gold, which exposes the flaws of fiat currency. He notes that holding gold is safer than dollars, as it is beyond the U.S. government's reach. This trend, he believes, is unfolding now. The U.S. dollar price of gold has risen 82% and 496% over 10 and 20 years, respectively. One was an inflation hedge, and the other protected your savings from inflation. Concurrently, Pento anticipates gold prices will rise significantly due to macroeconomic conditions. He warns of unprecedented deficits and debt, expecting a $6 trillion annual deficit in the next recession. He doubts the effectiveness of traditional monetary policy, foreseeing inflation around 3% unless a significant money market issue arises. Now we present the clips of MichaelPento's insights from his recent interview with Capital Cosm. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
I think in the aftermath of the next recession, we're going to have stagflation like we've never before imagined.
Yep.
But I think the next sector, my investment spectrum called the inflation deflation economic cycle model that I created, took me decades to develop. I launched it in 2016. It looks at the second derivative of inflation and growth. So I know where we are between recession and deflation and intractable inflation, sectors 1 to sector 5. I think our next sojourn is going to be in sectors 2 or 1, which is, like I said, deflation and recession. And then you'll see the inflation coming. Because I mean, the price of gold is real money. So, look at gold as measured in yen. It's going through the roof. Gold just exposes a fiat currency for all of its disgusting flaws. We've abused our world reserve currency status for a very long time. I think gold is benefiting from many things, not only the fact that inflation has already destroyed the middle class, but it's also looking at countries around the world that want to get out of dollar hegemony. So, in other words, if the U.S. government deems you a bad actor and they confiscate your reserves, that's not a really good option for countries with currency reserve surpluses. Just parking their reserves in dollars and in treasuries isn't really a great option. What is a really good option for them is just to buy gold that they hold, that's out of the reach of the U.S. government. So that's what I believe is happening right now. I'm not an expert in international currency affairs, so I don't know the mindset of every central bank, but I will tell you that the trend is inexorable to get out of dollars and diversify out of dollars, and that includes our other currencies and precious metals. That's a trend I see continuing. And there's plenty of gold to go around. It's just that the cost per ounce has to go much higher. And I think it will as a consequence of the macroeconomic condition that we have. I mean, we never before even ever dreamed in this country of having $1 trillion deficits, much less $1 trillion in interest payments in good times. Danny, we already have the national debt is 125% of GDP. I think we have about $35 trillion in debt outstanding. In the next recession, the deficit, the annual deficit should be around $6 trillion. That's my prediction based on the predicate being past history of how much the deficit goes up in a recession. And you're having $2 trillion deficit in a soft landing booming economy. That's what the mainstream financial media wants to tell us. It's a great economy right now, right? Certainly not a recession, but when a recession becomes manifest and the income dries up to the treasury and the automatic stabilizers kick in, you're going to go to $6 trillion around that figure. And who the heck's going to buy it at what price, what interest rate? That's the question. And that's why I'm very concerned. One of the main concerns I have about the next recession is that it's not an easy fix. Because the playbook is, hey, let's just take interest rates to 0% and borrow a bunch of money and everything's going to be okay. Well, you've done that since 1987, over and over and over again. And now you sit at a condition of insolvency and inflation that's very hard to control. I don't think inflation goes down to 2% anytime soon. I think it stays around 3% or higher. And the only reason why it would go back to 2%, and the only reason why I would be wrong or not wrong, inflation is going to be sticky around 3% unless and until we have a problem in the money markets, which is very possible, a high probability. And then you'll see inflation tank right alongside the economy.
During the interview, MichaelPento analyzed the Federal Reserve's approach to economic challenges, drawing parallels to the aggressive rate cuts of 2007 and 2008. He anticipates the Fed may cut rates twice this year, driven by lagging indicators such as the labor market. Pento warns against immediate rate cuts, fearing they could worsen inflation and economic instability. The market currently anticipates 1 to 2 rate cuts of 25 basis points each from the Fed this year. Lower interest rates reduce the opportunity cost of holding non-yielding assets like gold. Gold prices were set for their second consecutive weekly gain on Friday, as demand increased due to expectations surrounding U.S. Federal Reserve interest rates. Despite the government's enormous deficits and escalating debt levels, Pento predicts that the Fed will likely act too late to prevent a significant recession. He anticipates prolonged stagflation, fueled by aggressive monetary policies and economic imbalances. Let's get back to the interview.
The Fed was always late. Let's say the last time they went to an aggressive rate cutting cycle, not including COVID, they started cutting in the summer of 2007 when they had that Bear Stearns real estate fund, hedge fund blew up. And then from that point on, from the summer of 2007 to the end of 2008, they went all the way down to 1%. Sorry, not to 0, 1%. So it was pretty aggressive, but it was too little, too late. This time around, the Fed is probably going to, I think the Fed will probably do the same thing. They'll probably cut around the margins once, maybe twice, depending on how bad the labor market gets, because they're labor market Phillips curve economists at the Fed. And the labor market is if you look at the non-farm payroll report, which they all focus on, that's a lagging economic indicator, but they're all focused on it. So by definition, they're going to be late, as they always are. And they're going to be especially late this time because inflation is the big problem. If they aggressively, ex ante, started to cut rates right now, as Elizabeth Warren and crybabies on Wall Street are crying for, they did it right now. There's no guarantee that inflation would go down to 2%. I think it would most likely be guaranteed that it wouldn't go down. It would go up. The dollar would get crushed. Import prices would surge. Energy prices would rise. I don't know if the real estate market would really come down. So there's a chance interest rates would go up, especially long duration along the yield curve, out on the yield curve. But if they cut rates now, there's a chance that interest rates would go up because they're cutting. If they cut rates now, the U.S. government for the first time in forever is insolvent by many, many metrics and many ways of looking at it. It's insolvent. You got $1 trillion in deficits, $1 trillion in interest on deficits, $2 trillion deficits. The debt is 725% of our income. We're adding 42% every year to the deficit, 42% of our revenue to the deficit. Think about that. Think about going to the bank and saying, I want a loan, and you're 700%. Your debt outstanding is 725% of your income. And not that you're saving money every year, you're adding to your debt. by 42% of your income. That's no, they would kick you out of the door laughing. But that's the situation we have. So $2 trillion deficits, $1 trillion in interest. So you start cutting rates in that construct, interest rates might go up out on the yield curve. And then you also have the inflation problem. Like I said, I mean, inflation comes, the rate of inflation has come down. The rate of change has come down from 9% to 3.3%, but that's not 2. And it's going up from a level that's already, the price level has already bankrupted 3/5 of consumers. So the fact that it's still going up more slowly, but above target, shouldn't be a reason to cut interest rates aggressively, right? I mean, that's common sense. So he'll probably cut once or twice this year, Powell, depending on the repo market and when that reverse repo facility runs dry. Could be problems before then, but he'll cut rates ex post when it's too late. And then we'll probably have a very significant recession because of the 3 triumvirate bubbles existing concurrently. And then the Fed's going to cut rates to ZERP. And then the Treasury and the Fed will be monetizing helicopter money once again. And probably is going to be a prescription for stagflation as far as the eye can see. That's what I think is going to happen.
JP Morgan Research estimates that gold prices will peak at $2,300 in 2025. This prediction assumes a Fed cutting cycle initially delivering 125 basis points of cuts over the second half 2024, pushing gold prices to new nominal highs. Gold price predictions are based on Fed official forecasts, which see core inflation moderating to 2.4% in 2024 and 2.2% in 2025, before returning to the 2% target in 2026. How do you perceive the role of gold in your investment strategy amid current inflationary trends? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.